G'day everyone and welcome to this week's episode on the Scale Ups podcast. Today we are talking with Shawn Flynn. This is going to be part one of two-part episodes with Shawn Flynn. He is an investment banker. Don't be put off by the big scary name. He's not a big scary guy and it's all sort of corporate. He's actually super personable, but he's fundamentally an expert in doing transactions, helping people sell businesses in the 10 mil to like 300 mil sort of range. So if you're in the kind of business where you think you might get to $2 or $3 or $4 or $5 million in earnings, then this is a podcast you absolutely need to be listening to. And if you've got some intention of selling your business at some point in the future, we're really going to be sharing a lot of secrets as to how does the process work? How should you be preparing your business for sale? What are the things to be thinking about along the way? When should you get tax planning? What happens in due diligence? What are all the steps in the process for negotiating? What are the things that are going to impact valuation? What are the things that are going to make people want to pay less for your business rather than more? What's the difference between a strategic buyer and a financial buyer? And which one is probably the right one for you? So today we're going to tackle some of those questions. And next time we're going to be talking about the nitty gritty in some of the terms that you can negotiate that optimize the sale process. We're going to be talking about management meetings and how they work. We're going to talk about the challenges of actually running your business whilst you're also running a process and how you minimize the disruption to your company. We'll talk about brokers versus M&A advisors versus investment bankers and the difference. We're going to talk about some of the secrets on the buying side. So what are some of the games that get played on the buying side so you can help better prepare yourself for those? So there's going to be lots to cover. I think you're absolutely going to love today's episode with Shawn Flynn. And then please, of course, also join us for part 2 when that happens.
Welcome to the Scale Ups podcast, where each week you get to hear Shawn Steele, professional CEO, growth mentor, and advisory board chair, unpack the strategies that successful founders have used to achieve scale in their businesses. Stay tuned as he interviews the entrepreneurs who've made it, learns from industry experts, and follows a group of founders still striving to scale.
G'day everyone and welcome to the Scale Ups podcast, where we help first-time founders learn the secrets of scaling so they can fulfill the potential of their businesses, make bigger decisions with greater confidence, and maximize the value and impact they can have in the world. I am your host, Shawn Steele, and I'm joined today by Shawn Flynn, principal at a mid-market investment bank, focusing primarily, Shawn, on mergers and acquisitions, growth capital for the kind of, what would you say, like 10 to 250 mil revenue range, maybe like 3 to 25 mil EBITDA. Would that be right?
That's right. I mean, we focus on those transactions between 10 and 300 million. And the numbers you just said, those are the companies that fall in that space.
Fall in that space. And I guess if it was a SaaS company or something, it might be like, I don't know, 1 mil plus in recurring revenue or
SaaS has been insane the last couple of years. Like literally they could
$500.
It could. I mean, I've seen some crazy things. The craziest one I've ever seen so far was 40 times revenue. For a
40
company, 40 times revenue by a company that did barely 1 million in revenue that year. That's the craziest one I've seen to date.
Wow.
So
that's
there had to be something there in the tech that I just didn't know. But
jeez.
Yeah.
Somebody makes money out of that, so that's good.
Yeah.
Well, Shawn, you and I offline realized that actually we're twins, which is quite exciting because we've got the same first name. We discovered we have the same color in our virtual backgrounds. You're the only other person that I've seen like me who has a QR code linked to his LinkedIn profile in his virtual background. We're probably the same age. And although you've got a nice clean shaven head, I'm still working towards mine, but I'm getting pretty close. So nice to meet my brother.
Well, you just got me on the right day of the week. I mean, if this was any other day, you'd see stubble on the side. So
I love it. So, Shawn, today is really about M&A, right? So we'll talk a bit about our community, but our community is probably at that lower end of the kinds of clients that you work with. But therefore, there's so much value for them to learn from the kinds of clients that you support. We've got a lot of people that are in that probably 1 to 3 mil EBITDA range. And I'm keen to come back to your background before we kick off. But that's the space that I actually spent the last 4 years of my time doing acquisitions as well. And so there's probably a multi-part series for us here to unpack all the things that we might like to share. But really, I'm keen to unpack. We've got a lot of people in the audience who are this is likely their last business. Many of them are in that sort of like a 45 to 60-year-old range. They've built this business. Maybe it's taken them 10 years and they've got a certain amount of energy left for it. They want to realize some value at some point. So they're starting to think about their exit strategy. And today's really about talking through your experience and thinking about how do we help them optimize that? What does the process look like? What drives better valuations? How should they think about preparation? How do they think about incentivizing management? Should they be selling to a strategic or a financial? Like, there's so many questions, and there's no way we're going to cover them all today. But I think we'll just get started and see where it leads us, hey? And then if we need to do another episode, then we will. But your background, I just thought I'd start there because you didn't start life as a typical kind of investment banker, kind of following the typical path straight out of uni into a top tier consulting firm, into a graduate program, and then straight into kind of investment banking and junior analyst roles. And it seems like there's like a designed path to get to get people into your role. And you took a completely different path, starting with founding and scaling and exiting a business in Beijing. Can you just give us a quick insight into that journey? Because I think people really will get some value out of the fact that you come with a different perspective.
I mean, you're 100% right. I'll go to many events and people go, wait, what'd you do before? Like that background, I've never heard it before. It doesn't make any sense, but it kind of does make sense when you put all the pieces together. After uni, well, during uni, I really wanted to travel abroad, but I was doing mechanical engineer. Because of that major, I just had to be heads down in my books in order to graduate, whereas all my buddies were taking a semester or quarter abroad. We were on the quarter system. And so the whole last 2 years of university, I was like, okay, as soon as I graduate, I'm going abroad. Once I graduated, I went down to Costa Rica. I thought I was going to be there for a couple weeks, stayed almost 2 years. From there, I was doing some research. This was 2005, 2007. I was seeing that China was taking over the world. They were opening up call centers in Costa Rica to speak Mandarin. And I was like, oh my gosh, this is just crazy. What's happening here? And I thought, I don't want a real job. Let me go to Costa Rica, or not Costa Rica, from Costa Rica to mainland China. I'll stay there for a year. I'll learn the culture, language. I'll do everything that I did in Costa Rica, but there, and it'll really put me in a good position for the rest of my life, being a mechanical engineer that speaks Spanish, that speaks Mandarin, from Silicon Valley. I was thinking, okay, every door will open up in the future. And we'll get back to that because it really more closed than open because of that. But I went to China. It was more difficult than I thought. I ended up staying there almost 5 years. In that time, I did go to Europe for about 6 months before going back. So I was abroad for a total about 8 years after college. I had an okay exit. Partner bought me out for a company we started. That was the third company I started in China. The first two were complete disasters that I learned a lot from that allowed the third one to actually be successful. And those two others are stories that whenever I even tell people here, they shake their heads like, nah, that didn't happen. That didn't happen. I'm like, no, that really happened. And even the third company, people most of the time don't believe me. But yeah, partner bought me out, came back to the US 2013. Normal corporations, big companies thought I'd all quit. They're like, you're going to get bored here in a year. I mean, I was interviewing at some of the, Salesforce, Hootsuite, all these big companies here in Silicon Valley, and they all said the same thing. You'll get bored, leave. The startup ecosystem loved me. Because of that, I got connected with a bunch of angel investors. I started helping out one angel group, the second oldest angel group in Silicon Valley. It went from me just helping to then being one of the deal screeners. And then after a while, I was the investment director of this group. I'd look at 100 companies a month, filter it down, get on calls with 20 or 30, filter that down to meet with 10, 15, and then bring in 5 or so to meet with the members to actually pitch to, and maybe one would get a check. And then I was doing deal flow agreements with all this new money coming from mainland China. This was back 2017, 2018. I spoke Mandarin. I was with this angel group that had 20 years of connections in Silicon Valley. I could speak to this one group that had no connections but had money, and I was pairing them off in some deal flow agreements. One group said, hey, come on board, work with us. We're backed by this very large land development company in China. They're building all these tech parks, and we want someone to help take companies from here, set up their operations in China, and vice versa. I did that for a number of years, got to know a bunch of investors in that process because I was making intros to everyone. And an investment bank that I made an intro to that made a lot of money was like, hey, you should just come on board. We'll sponsor your licenses. And then that was one. And then when the pandemic started, I switched over to the one I'm currently at. So you had this crazy path of just doing one thing after another, always pivoting. But when you look at the skill set you have, okay, good with people, adaptable, able to listen, able to create stories and match people based on investment theses from listening, mechanical engineer background. There's a lot of components that really apply
Mm,
to the investment banking that I'm doing right now. So there's a lot of times when people literally call me out in groups and say, "Hey, you never went to Harvard or Stanford or any of these places. What
yeah.
makes you qualified investment banker?" And I'll say, "Yeah, I've been parts of billion-dollar real estate transactions, and I've been parts of this, and I've been parts of that throughout my career. And if I'm able to at one time do contract negotiations in Mandarin, the writing and everything, I think I can handle the deal we're working on now." And that normally shuts them up. So
I love that. Well, it's funny though. It's not until you've actually got the hindsight later on that you see all the ingredients that have come together that all make, that all help you with whatever it is that you're working on today. Like I've got a 17-year-old, so he's just about to go out into the world. And so helping him think about his future and going, hey, mate, like, don't get tied up in the path because that's just such a great example of every pathway leads to another pathway. Just be decisive. Like just go after stuff that seems interesting where you're going to learn, and each one of those will fork off into something else. And at some point, those ingredients will come together and really help you. But like, don't get all swept up in I have to design this perfect pathway because that's where everybody else is going. It's like just forget about it.
I mean, some of the craziest stuff I've done in my past have turned out to be the most beneficial. There's a time there as a personal trainer. You'd think like, how does that have anything to? It taught me how to take goals, break it down into smaller goals and smaller chunks, and create this,
Mm.
6 month, 1 year timeline. I substitute English teaching sometimes when I was in mainland China. Taught me same thing, course catalogs, how to all these things apply to investment, all these things apply to business, all these things
Mm.
apply to processes, everything. And we could talk about that later,
Yeah.
but it's crazy the things that one time in your life people laugh at and the other times you're like, "Hey,
Mm.
it's moneymaker now." Like
Yeah, absolutely. No, I'm with you. Well, I mean that yeah, probably that gives to our audience a good sense of the fact that you've done a lot of things that are going to be pretty relevant to our conversation today, and taken a bit of a different path. So I really like that. Maybe we can set up just almost an avatar, if you like, because there's such a range. We had a good chat offline about the fact, well, a business that's doing $1 million in EBITDA versus a business that's doing $5 million in EBITDA actually has quite a different set of I mean, the business obviously looks quite different in terms of its maturity, in terms of its leadership structure, in terms of the kinds of buyers that are going to be interested in that sort of size. So maybe I thought we'd take a bit of a sort of hypothetical based on maybe a typical founder in our community. Well, let's say someone who's 10 mil in rev, 2 to 2.5 mil in EBITDA, so that 20 to 25% EBITDA. Let's say they're a training business, maybe they're selling. I know they're selling courses for people to look to change careers. So they don't really have recurring revenue. They've got a pretty transactional services business, but it's consistent and it grows each year. And it's got some key leaders in place. There's some sales managers and marketing people and a reasonable, no C-suite, but a reasonable, management team that's capable of running the operation. But fundamentally, the founder's still the CEO, late 50s. This is the last business, not interested in doing anything else. So happy to stick around for, earn out periods, like not in a rush to get out, but trying to figure out the right time maybe to sort of create value and thinking about what their options are over, say, the next sort of 3 years as the business grows. So we can come back to that as almost the person that we're talking to today. But maybe if we start from your perspective, Shaun, what a lot of founders, because the vast majority of founders in this community will not have sold a business before. And so they don't even know what the process is. Like what is involved for a founder? So can you just maybe just take us through at a high level steps in the process
ooh, good. And I really like that
in selling your
example or
business?
the company to use. I really like the number. I like everything there. I think that's a perfect example to use. So before the transaction, so we'll break it down into I guess three parts, and then that middle part even break it down further. So you'd have before even going out and hiring the investment banker to go out to market, you'd have the whole process, and then you'd have post closing. So even before the investment banker comes in the picture, probably should talk to a wealth advisor, tax advisor, all these people on your core team. Find that lawyer you know that has some experience in MMA that you like, that accountant, just all these people that have that experts in the past. The reason why is, yes, you can find them during the process, but then you'll be rushing it, right? You might
Mm.
be getting recommendations and you're like, this person doesn't really fit my
Fit
risk
me. Mm.
profile. It doesn't, we don't mesh. Like, you don't want that lawyer that's sitting there going, okay, I'm at the littlest thing, I'm stopping this deal. if your
Mm,
personality is, hey, we're going full steam ahead, I'm selling this, that's it. What's that on a scale of 1 to 10, that risk tolerance? If you're a 2 or a 4 and your lawyer is a 9, that doesn't work. But if
mm,
you're a 2 or 4 and the lawyer's a 2 or 4 and the account, everyone involved has a similar risk profile for the deal's going to, be comfortable for everyone to move forward at each of the steps versus this person fighting with this person that's fine with this one that's fine with that one. So get to know your team early on, and that first year, even before you hire the investment banker, talk to that investment banker. Say, hey, a year from now, 2 years from now, I'm thinking of exit. What should I do? And he'll probably say, or she'll probably say, you know, give me your last years of financials. Let's create, do you have everything in like a mini data room just so I can kind of learn about this business so I can give you some feedback on it? Is your customer concentration too high? Do you have
mm,
all your sales and marketing processes built out? Have you been tracking these metrics? You have or you haven't? If you haven't, okay, for your industry, we should really be tracking these. Let's look at the lifetime value, the cost of acquiring a customer. Let's talk about all these, maybe your net promoter score. Let's see how those change over time, and let's see them going in the right direction, because we can fix some things, but some things take longer time. And maybe you'll
mm,
want that 1, 2, 3 years of this data before going out to sell it, so you have that maximum value. And we can definitely, and every industry is different. So one industry might want these metrics, another might want these other. Um, find out what your business focuses on and see if you can get those numbers better than average, better than the competition out there, so you can get that
mm.
premium. So now we're moving into, okay, it's time to actually sell the business. And that process, a lot of people think, okay, if I start October, we're going to be done by year's end. And that's not the truth at all.
That
I've
is
had
not
people
happening.
come to me saying, hey, this is going to be a quick transaction. I want to get this done before Christmas. And you're sitting there going, wait, what? Excuse me? Hold on. The reality is, these processes take time. There's a lot of steps involved, but some steps can be moved a little bit quicker than others, especially if you're prepared for it. So think 6 to 9 months. I mean, really think
Yeah.
6 to 9 months on average, and it might go longer. It might go up to that year, because who knows what's going to happen in due diligence. Maybe the economy
Mm,
changes. Maybe something happens that buyer is 30 days in, they pull out, they say, hey, I can't for
yeah.
some reason. And then you're going back out and to one of the other people that
Yeah.
might have submitted an LOI, and we can go into all that and then having those conversations again. But let's go back to this whole process of, step one, you're going to be building out a data room. Now, if you've gone out and
Hmm.
raised capital, you're probably familiar with it. Or, if not, a data room, all it is putting all the information of the business in one central location. And that information would be, the last couple years of financials, a pro forma that's thought out and believable, not just, okay, we're going to scale 300% next year. It would have to be, okay, we're going to
But we
scale
only did
for,
15% last year.
we only did 50, and our discounted cash flow analysis puts us at $100 million company, because look at
Yeah.
this, we go from here to here. And you're like,
Yeah,
great.
all we have to do, we're just going to add 20 salespeople at exactly the same time, and they're all going to start delivering to 100% capacity on day two. So it's an easy spreadsheet calculation.
And zero account executives to service those accounts, and
That's right.
and somehow we have
Yeah.
an app in the Apple Store, but we don't have an iOS developer. And
Yeah. Yeah.
exact. I mean,
I've seen those spreadsheets.
oh my gosh,
Oh,
it's yeah, it's pretty hilarious when someone's like, yeah, I just take this one spreadsheet I found online and I adapt it to my business,
oh
even though
man.
it's not related to my business, and come up with something else. And here you go.
Actually, let me tell a story about that briefly, Sean, because last year I was helping a publicly listed company do some acquisitions in the education industry, and we were looking at this business, and it was actually it was in a business that had basically was going through a bit of a turnaround. It had a sort of a tail off period. They'd installed a new general manager. A new general manager was absolutely the right guy. He was doing an excellent job. He turned the business around. He'd restructured the cost base. He'd restructured the products. Like everything was going in the right direction. And they'd sort of had this bounce from they were doing 2 million EBITDA, then they did one, then they did pretty much nothing, then they'd bounce back to one. They were back to maybe two or something. And the next year they were going to do 7.5. And the following year, they were
Wow.
going to do 17. And I was like, hey, guys, this is great. But let's just talk about the assumptions that underpin this model. And what was really interesting was and people don't necessarily recognize this in the process, but that document was the primary thing that made this was an excellent business. And I was having to advise this company to say, actually, guys, just forget the financial model that you've got in front of you. We'll build our own model, right? But the business is excellent. It's got the good bones, it's got a great leader, it's got all the things that we want, and it's not going to do those numbers, but it is going to do something that's positive that we're going to get a return on. So we'll obviously rebuild that model and then we relook at it. But as a result of seeing that document, they were like, well, I just don't believe it. Like, if they're going to put that document in front of us, what else are they going to put in front of us? What else are we going to find in due diligence? And, people don't often appreciate that, like, a big part of this process is building trust and transparency and believability. And so I said to the CEO, I'm like, mate, you didn't put this document together, did you? And he was like, you've met the owner. He's like, that's what the owner wanted. And I was like, the CEO just could not get the owner to put in the data room the financial model that the actual CEO believed in. He had a model. He knew what the numbers were, but the owner wanted to really inflate it, thinking they were going to get some massive sale price as a result because everyone was going to believe it. But actually, everybody not only didn't believe it, we didn't buy that business and we exited the process because they'd just gone to town on some crazy assumptions that were not believable. So they absolutely scuttled the deal that could have been a good deal for them.
I mean, I think you're right on the point when you said trust there. Because, I mean, the data room, this whole process is de-risking the investment for the buyer. And if they can't see that, if they you're right on point with that. I mean, the whole process is to build that confidence, that end person, that this company, that it's going to be, predictable, transferable revenue, that this is how our models are actually going to play out. And if they see something like that, and yeah.
And actually, interestingly, as you say that, when I think about a data room, I've seen founders before have this desire because they've never had to open up the coat before, and so they're a bit scared of kind of putting creating a lot of transparency in there. But the advice from me is always, if you don't put that information in there, you're incrementally increasing 2 to 3 weeks of time every time there's a key document that's not in there because someone discovers it. They're always going to ask for it. Like, I give most clients a sort of standard list, 100-point sort of DD checklist. I'm like, this is the standard stuff before we even get to your industry. This is like, everyone's going to want to see these things. So just get on with it and giving it to them, because otherwise they're going to ask questions in the process, which is going to take you time. You won't have developed it. You're going to have to go and develop it whilst you're trying to run the business. It's actually just making your life way harder. Like, do that upfront work, get all the information in there, to your point. So they go through the DD process and go, what the best thing that you could get as an outcome is they come out of the DD process and say, there was nothing that we discovered in the DD process that you hadn't told us. Like, no red flags. Just, it was exactly as you said it was going to be.
Well, to add on that, I mean, 2 things. One, when you add everything to the data room at the very beginning, that investment banker, whoever you're working with to create the market materials, has more information to go on. And the last thing you want is to create this SIM or this piece of information that gets sent out there that has a number that when they check a data room later after they've gone through that, they see something that's contradictive. And they're like, wait a second. The
Shaun,
SIM
people may
says,
not have heard the acronym SIM. Can you just explain what you
sorry.
use as SIM?
So, confidential information memorandum. So the data in the data room will be made into a piece of marketing material. Normally there'll be a blind profile. So that has, like a teaser, something that just has enough information on a company to kind of whet their appetite to find out more. It's not going to have enough information to know which company it is, but it'll say, the sector. It'll talk about, maybe the financials the last 2 years and the next 3 years predicted, maybe some key customers, some things about the business where the person that gets it, the private equity group or the strategic, will go, hey, I want to know more about this company. I'm very interested. I'm going to spend the time. Then they'll sign normally a non-disclosure agreement, an NDA, which says, this information, you can't share with people. It kind of protects that confidentiality of it. And then they'll get a SIM, which is a confidential information memorandum, which is basically a summary of the data room. So think of a 60-page document that really goes into the weeds on this and really gives the end, either private equity, strategic, or whoever, enough information for them to go, okay, we're really going to dive deep into this. We're going to make an offer. We want to set up a management meeting. We want to spend a lot of our resources to find out about this company, because we're really serious about moving forward with this. So
Mm.
that sim, if you create it and then later on there's information in the data room that's been updated since the sim got sent out and it's conflicting, or this information they're like, hey, that's kind of key. Why wasn't that in the sim? Huh. It brings up questions again, and that trust
Mhm.
factor, and the
Mm.
because their side is going to be analyzing everything because they don't want any liability, they don't want any surprises, they want to model out everything. A lot of people on that side of the transaction, the buyer side, are looking for ways to kill the deal. There are those, definitely those champions
Mhm.
that want it to happen, but then there's other people on that team that, hey, their goal is to make sure it doesn't. So
Mm.
so back to the process. Oh, and talk
Mm.
about the data room, how granular I've seen it. The most granular one I've ever seen so far, or hypothetically, because I don't know, I'm supposed to talk about things, I guess, is one founder had the transcriptions for every podcast they've ever been on in the data room. That was the most, and the people on the other side went, "Oh my gosh, I've never seen this." And because of that, completely trusted the whole process. They were enamored. They're
Mm.
like, "I've never seen a data room so clean and so thorough in my life." And these people
Mm.
had been doing transactions for years and years, and when they saw the every podcast the
Mm.
host had ever been on transcribed in its own folder, they went they
Wow.
their
Yeah.
jaws dropped.
They're
So,
clearly organized, willing to be transparent. Like, yeah, it breeds trust. And some people people may not realize this, but I've been in organizations where, as part of the deal team, we might have 6 or 7 people working on this deal. There's a lot of resources often being deployed to, and it could be obviously significantly more if it's a really big business. But we also then would have a the deal team would get split into two and would essentially debate the deal. You'd have a kind of a team voting for the deal and having to present the reasons why we should do the deal. The other half of the team's job is to figure out why we should kill the deal. And that's kind of the investment committee, is like the two opposing sides present the case, and then a decision's got to be made. And it's a really interesting process. But so, to your point, there are people looking, and there are people who will have their sort of rose-colored glasses on, looking for all the reasons to do the deal. And so, yes, your financial projections and how amazing the business is going to look is going to be key. But there's just as many people, if not more, looking for every reason not to do it, because this is a risk assessment, right? Like, if we deploy this money, how risky is it? How likely is it that we're going to blow that money up or go backwards? Because that's not going to work well for anyone. So they're going to spend time on it.
all right, going back to that whole process. So, data room is being built out. It's got all the articles of incorporation, everything you can think of there. You've built out the marketing materials. We talked about the blind profile. We talked about the confidential information memorandum. We're also creating the buyers list at that time. If this is an active process, if it's a passive process, what I mean by passive is there's some people that will go to groups that just basically put the company on some websites. They might have a few buyers that they know for this size of a transaction. An active process, you're out there emailing, calling, everything. You're bringing the buyers in. You're contacting
Mm.
them directly based on their investment thesis. You know who you're targeting. You've created that information from databases, from your network, from 30 years or whatever in the space, and you're going, okay, this deal based on the parameters that they invest in fit perfect. You're matching it up, sector, size, check size. I mean, you're not going to bring a deal that's a $50 million deal to someone that writes a minimum $100 million check, or
Mm.
maximum a $20 million check. It's gotta
Mm-hmm.
be that fit on both sides to maximize everyone's time.
Yeah.
Then it's going to go from there. Depending on the deal, it might just go to LOI or an IOI, indication of interest or a letter of intent. Both are non-binding, but the indication of interest is normally, hey, we're roughly estimating this company at a range between EBITDA 5 and 6. It's you know more broad the information, and hopefully in advance, if you've kind of done the process right, you've told people, hey, this is what we're looking for. We're looking for you to put a valuation on this company for what reasons. We're looking to show that you have the capital to actually invest in this company, or where it's coming from. Hey, we're looking for just some overall information. Then from there, you're narrowing the funnel. So the whole thing's a funnel process, right? From that
Mm-hmm.
very beginning where you're messaging everyone, to that more narrow, you're getting these indication of interest, to that more narrow, you're getting that letter of intent, to hopefully you find that one buyer that fits perfect, whether it's strategic or financial. Then you go into due diligence. Hopefully you can get that done in a reasonable amount of time, maybe 60 days. And then just, definitive agreement, everything's transferred, you're good. And then it's that integration post transaction time. So think maybe a year to 2 or 3 years to prepare, 6 to 9 months that transaction, and then however long the integration after. So you're talking 3 to 5 years for a proper sale versus, hey, let's do this in 3 months, which a lot of people think.
Yeah, 100%. So let's talk about then, because I'm conscious how much time we got today. I know one of the things that obviously the meat on this topic for a lot of people is, how do I maximize the valuation? What are the things I need to be considering in a business this size? So we talked about the sort of, $2.5 million EBITDA on a 10 mil revenue base. We've got some leaders in place. What are some of the things that you think will help them optimize value? And then we'll talk about some of the things that are probably going to reduce the numbers of people they can sell to, or increase the risk profile fundamentally, and therefore make it less likely that they'll get a decent price.
So to start, the first thing, even before to maximize the value, is think about maximizing what you'll get out of the deal by talking to that wealth advisor, by talking to that tax advisor. Because the last thing you want is getting this check and giving 40% to the government, when in reality, if you've done just tweaked little things, you give almost none to the government. So talk to those people far enough in advance to also kind of plan out that exit of, hey, what I want to do with the rest of my life will require me to have an exit of this size. And then you can kind of judge your company. So for the example right there, maybe you're thinking, okay, I could sell this company for 10 million. Maybe you own 100% of it. Well, you've talked to your wealth advisor, you've talked to your tax planner, and they say, if you get anything above 6.5, 7 million, you're going to live life the way you dream. It's all planned out. Here it is. And the person's going, okay, perfect. So I have that great margin on both sides. So I'm pretty sure, when I go out to market, I'll be able to fulfill everything I want to do. Versus that other person that might go, I'm not planning out anything. I have this big dream. And then it's a sudden surprise when they go out to market and like, oh my gosh, I can't realize it because I'm paying all these taxes. I should have done these changes to increase it within this range. And so before start planning and know those numbers that you want to hit so that you have that lifestyle post sale that you dream of. That's the first advice.
Yeah.
Then for the company itself, and Shaun, I'm sure you can share some stories of founders you've talked to that you just kind of shake your head and you're like, wait, why did you start planning this after the transaction was done? Why not before? So,
yeah, no, I'm with you. And actually, I think probably one of the hardest questions for founders is they haven't really thought about how much money they need post transaction. Like they haven't actually done the thinking to go, well, this is what I would be happy as long as that's the number that hits the bank account. They haven't actually done that thinking. So it's quite difficult to reverse engineer it because, as you said, once they go, oh, 5 million sounds like a big number. And you're like, okay, yeah, 5 million, less costs, less taxes. Oh, there's two of you. Okay. Like the number's starting to get a lot smaller. Like this may not be a life-changing amount of money anymore. Okay, maybe they can pay their house off, but maybe not a lot more. And so, fundamentally, what are you selling when you think about the multiple? You're selling future earnings, right? So it's like, well, if I only can sell the company for 3 times EBITDA, well, if the business wasn't even growing in the next 3 years, I'd get that EBITDA into my own, or I could take that EBITDA out of the business depending on the kind of working capital profile. It's like, well, that's what you're selling. You're selling future cash flow. And if the business is growing, you're going to find that you actually get that number pretty quickly if you just hang on to the business and keep growing it. So there's a real sort of dichotomy there. But to your point, the starting point is, well, what is my kind of walk away minimum? And then assuming you've then understood taxes and thought about costs on top of it, then you get to a sale price, and then you're getting to a sale price versus your multiple. And then now we're into well, is that a reasonable? Do I need 12 times? Or can I actually get that outcome on 3 or 4? Then obviously there's a lot of factors in terms of the business. But yeah, let's talk about some of those factors then. Okay, let's assume they've let's say in this scenario, as you said, let's say if they were to sell this business for $10 million, so 4 times EBITDA, they're comfortable with the walkaway price. They've done the tax planning. They think that's going to give them the lifestyle they want, and they think that that's sort of achievable. How do they then think about the optimization of that? How do they get sort of more, and what things would be likely to contribute to them getting less?
Perfect. And to add on that last, just one other thing that having that kind of that number in your mind that is key to the whole process is you'll have the number from your walkaway point, and that keeps you sane throughout this whole journey.
Mm,
Because one thing that I think your listeners, when it's their first time going through the process, they're not gonna understand the highs and the lows until going through it. And I mean, Shaun, you're smiling, so I think you've seen it. Whereas,
yeah,
you go
a
out
lot.
to market, you might not be getting offers that you thought on that first week, and you hit these lows, or you start getting offers and your significant other's already spent the money, and you start
Yeah.
freaking out, going, "Wait a second, the money's not in the bank. What are you doing buying this or buying that?" Adding stress, or
Mm,
the keeping it secret from those colleagues or your employees that you've worked with for the last 8-10 years, thinking in the back of your mind, I might have to let some of these people go, or what's going to happen, or even that this is been my identity the last 10 years of my life. What am I going to do post? So having that thought out before the transaction, having those numbers, having kind of that visualization can keep people more sane throughout this very, very emotional journey. So
mm,
wanted to add
yeah.
that. Now
Yeah.
going into
I
the
think that's
numbers.
super relevant. Mm. And actually, can I just say one other thing? One of the things that I remember one of the first negotiation skills courses I did really talked about, you have to understand your BATNA, which is your, I can't remember what it stands for now, best available alternative. Do you remember what it stands for? BATNA?
Yeah, best
BTNA?
alternative.
Best best alternatives. It's basically essentially,
Your walk
your
away
sort of
point.
bare ass
Yeah.
minimum. It's what your walk away point is exactly. But the number of processes I've been in, I always just found this super fascinating. The first time I got involved in M&A, there was a there was a deal where where the seller had said, well, we can go through the process and we can talk, negotiate, yada yada yada, but basically we're not going to be selling it for any less than 7 times EBITDA. Like that's it. Like it was just right up front, and they just and so and that was probably a premium for that market and for the business, and actually it was probably worth 5. But they were like, we will not be, no matter what comes out of this process, we will not be selling to you for less than 7. So please do your due diligence. Please come and negotiate anything that you think kind of needs adjustment, but recognize we're still not going to sell it for less than 7. And I was like, that's so interesting that somebody would be that sort of bold and brassy. But in the end, the number of conversations that it influenced on our side as we were the potential purchasers, um, people would come back and go, yeah, we could do this and we could do this. And we've looked at this in the model and we think there's probably a discount opportunity there. And this thing over here, like we need to normalize that out and so on. But then it just continued to come back to this, this dialogue that I had up front, which is like, yeah, but they're not going to sell it for less than 7 times. So there's no point going to them and saying, well, we think it's worth 5. They're not even going to entertain the conversation. So we've either got to decide, are we in or are we out? And it was so interesting that they'd actually, I'm not sure if it's always the right strategy, that's for sure. But because, fundamentally, you're essentially setting a price. Maybe you could have got more. But anyway, this actually, because they wanted a premium and it was actually a good business, it just put a floor limit on the thinking of the purchaser. I don't know if you've seen that much, Shaun. I'm sure it works out badly sometimes because it probably could have knocked us out very easily. But in the end, it didn't.
What's kind of crazy with that one is, I mean, I've talked to other investment bankers about that, going, "Hey, what happens when you're working with that engagement where the person sets that floor that is just unrealistic?" And some people just come back to me, they're like, "It always changes when there's real money in front of them." I'm like, "Oh."
Mm,
So I mean, but
yeah.
I've seen different. I've seen where
Yeah.
it doesn't change. Where
Yeah.
that number is the number, but then I've also seen where, hey, once there's a real check and they go, this is real money. This changes my
Mm,
life.
mhm.
Okay, I will.
Maybe I'll
I'm more
capitulate. Yeah, that's
flexible
right.
now.
Yeah, these guys didn't, but yeah, I think it's definitely possible. So yeah, not certainly not advising that that's a great starting point. But to your point, they had a very clear price. They knew what their walk away was. They weren't going to have a conversation or anything less that, and so that it actually for them it actually strengthened their position, didn't weaken it. So
One thing
let's
for
carry
that
on with
though,
that.
also for all the people you're talking to, your advisors, that early on, talk to them about your flexibility. So
Mm,
just piggybacking on that, where you had that one that said, "Hey, this is the floor." You could always be, okay, this is the floor, but I'm gonna be very flexible with my terms. Whether it's,
mhm,
that cash component, that earn out, the seller's note, the roller, whatever, just, hey, I got this number in my head, but I'm flexible with everything else. So get there, or hey, this is a line in the sand for the cash component only, and everything else is gravy for people to compete against or whatever it is. But relaying that flexibility early on and having
mm,
conversations of what all those mean is huge. And maybe that, I mean, maybe I just threw a bunch of words out there. I've noticed a lot of people don't quite understand a seller's note or an earn out or rollover and all those terms.
do you want to
But
explain those quickly?
yeah, so think of it this way: there's a lot of different components of that are possible in a transaction. You have that cash component, which is, this is the amount of money. Great, it's the most secure. You know what you're gonna get. Then you have the seller's note, which is, the IOU, the debt component, where they're gonna pay you back, and if not, you have a recourse. You're able to, have a recourse component because you're on the debt stack, depending where you are, whether first position, second, or whatever. But they'll pay you that money. The earnout, it will be tied to something, whether maybe it's your time of employment there, revenue, EBITDA, something like that, where if these things are met, then you'll get paid. Rollover is cash in the new entity, and all that stuff. And there's more, but you can play around with these so much, where it's maybe that seller's note is over a 5-year span, maybe it's over 3 years, maybe the first year there's a holiday where nothing's paid and then it's monthly, or maybe it's every quarter, or maybe it's small amounts with a huge balloon. Maybe the earn out is, so with the flexibility of all this financial, however you might call it, those numbers can range quite a bit with what the buyer gives you, because they're going to look
mm,
at their risk profile and go, okay, cash is this risky, sellers are this risky, earnouts this risky over this amount of
mm,
time, and we see in our models this way. So we're able to give this higher number to them. And if you're open to these types of conversations, yes, it is more risky on the seller's point for each of these things, but you can get those higher numbers. And sometimes the seller would like that because, well, this money is deferred. I'm not paying taxes. This is part of that wealth building strategy. Hey,
mhm,
actually, it's getting better interest because there's an interest on that debt, the seller's note, that's higher than the banks are paying. Hey, actually, I'm really liking these people that are acquiring us, this private equity group, and I think in the next 3 years they're really gonna increase this company. And when they sell it, I'd like to get a win then. So maybe I'll roll over some in this equity component. And being open to these conversations can change the dynamics of the deal
mm,
completely. So have
yeah,
those conversations early on with whoever you're working with, because when they have their conversations, they can mention this. Hey, yeah, my client here, they want this number, but they're really flexible on how to get there. Or hey,
mm,
the client's looking for at least minimum this much cash on closing, and then these other components, they're flexible. It's just saying that expectations for the flexibility in the terms of the deal, and it could change everything in the conversations you're having with the buyers. So
yeah,
something
yeah.
just to think about on day one going into this sale, of the numbers you need to hit when you're talking to your wealth advisors, your tax planners, that, because each one is handled differently. And that was a lot there. We could do a whole episode on that, I think.
Yeah, yeah, and I agree, and I think it really does. I guess it's like a property transaction, right? Where you may have a particular number, you might be really flexible on the settlement. You may be happy to fix some things before the place gets sold, or you may be like, no, I want this, unconditional 30 days, no conditions whatsoever. But I'm willing to take a haircut because I don't want to have to deal with all the other stuff. It is about kind of flexibility of terms, and to your point, there's a whole open conversation there. So maybe that's one we return to in our next chat. So then, if you think about, because obviously those things can really help you to optimize the deal. As one example, your business might be on a great growth trajectory, and you might be quite happy to hang around for the next 12 to 18 months because you love the business. There's no major kind of risks from your perspective. You'd be maybe you weren't even looking for a sale, and you got an offer that you weren't expecting. Well, if you've got another 12 or 18 months, you might be quite happy with an earnout because you'll get, a multiple on last year's EBITDA, but actually you'd really like a bit of, a better multiple on next year's EBITDA, and the blending of the two gives you a better outcome. So to your point, you might still want a cash component that's X dollars on day one, but you're happy to take a balance because you think you'll actually make a little bit more. But there's other founders who'll be like, I want to be out of here in 30 days.
Yeah.
30 days post sale. And I've seen one of those recently where the company that was acquiring wanted to hold back sort of 10 or wanted to have, 10 or 15% of the price attached to an earnout, essentially the following year's financials. But they also wanted the founders to leave within 30 days. And I was like, hang on a second. So they're going to be in control of the business, but then you're going to have 10 to 15% at risk? That doesn't make any sense to me. Like if you're staying around and you've got influence over the outcome, great. But if you're not, then that seems a little bit interesting. So anyway, there's probably a whole, maybe we do as part of a podcast too with you, Shaun, we'll talk about terms and some of the opportunities in there. What about just straight up things that you think an investor's looking for in a business like this that's going to influence them wanting to pay a higher price versus things that are likely to make them want to push hard for a discount?
So let's go back to the answer of de-risking. So how can we create a situation where the buyer is looking this as little risk as possible with the business as a whole? So there's no concentration of clients. You don't have those clients that are making up 30, 40, 50% of sales. There's a lot of clients making up small amounts. So if you lose a couple, no big deal. You have those founders or the people on the team that maybe step out, but the business is still running because the processes are so well laid out where everyone there knows step by step what to do. You have the numbers that prove this over time, where it's not, okay, for the last 3 months, this is our lifetime value of a client, but no, it's actually been the last 2, 3 years we have the data and they keep getting better, better, better. And there's a trajectory. Here's everything we've changed. This is what we're doing now. It's basically this book that you can almost hand them like a manual for every component of the company, all laid out, thought out. I mean, that's when you get that premium on the company where it's, hey, these systems have been thought out, they're proven. Look at the track record, look at all the components. We're good with this. This is going to add to us. We're confident it's going to hit these numbers moving forward in all our projections and what they're telling us. I mean, those are the companies that get that premium when you look at their metrics versus everyone else in the industry and say, "Oh, they're better here, they're better there." That gives them confidence, thinking that, okay, the money we're investing, we're going to get our money back at a multiple we're happy with. So that's when you're building out that business for sale, you should be looking at it going, okay, where are my numbers that are, not above industry average? The cost of acquiring a customer, or maybe, there's things of that people for some reason don't put value on, but there is value, such as likes and all that information on the web, 500 5-star reviews, this social media, the keywords. Hey, there's companies I've talked to that are like, yeah, we're top, SEO for these keywords that drive this much organic traffic and that, and they won't even mention that to me until months in the conversation. I'm like, hey, how do you get so much organic traffic? Oh yeah, well, all this SEO and everything, we rank on these keywords. Like, that has value. That has a ton of value. So I guess I got a little off track there of just, there's a lot of value that people don't see in their companies. If you there just the other day I was talking to a buddy of mine, and he was telling me that there's a company he's working with that, I'm not sure if your fans have, you know, fans of basketball, if they've watched Golden State Warriors and that. It's a health company here, and they were interviewed years past with the Golden State Warriors going to their facility after a game to decompress in like the ice saunas or whatever they have there.
Yeah,
And
ice bath, yeah.
it was on page 8 of their website that no one knew about. And you're like, wait a second, the Golden State Warriors, best basketball team, like, one of the best in the world. You got Steph Curry video on the news. How come that's not everywhere? Homepage, that's a huge marketing piece. So there's all this collateral that has value. But more than anything, I guess just a company that has the processes built out that step by step that people can follow, that everyone on the team and the culture, company culture is a huge value add.
Mm.
Um, I mean, is that culture one of we're gonna be working if we get acquired in the right manner, or is everyone gonna take what they can and take off? Or
Yeah.
uh, I mean, there's a lot there, but it
But
all
even,
comes
and
back.
if
Oh,
you think about even just when you're often thinking about metrics and things that you're going to want to show, okay, so go back to our $2.5 million education business. And as you
mm,
said, we're going to want to be able to show consistent improvement and planning and sophistication in all of the lead generation relevant metrics, the sales metrics, the lifetime value, the cost of acquisition, yada, yada. But actually on the cultural side, people often leave that completely out. And I go, wow, like where's your employee engagement survey that's got some transparency about actually where how people feel about the company, how people feel about the product and the reputation of it and the leadership and their engagement with leadership and are they getting what they want out of the role? And you may not have, it's not about having perfect scores and everything. It's about showing, hey, we got these results, 2 years ago. We addressed these top 5 issues. And then the following year that went from, 78% engagement to 84% engagement. And that's a great improvement. Like it's actually that transparency and that proof that you know how to improve the business, you know where your gaps are, that builds trust, but it's an easy way to help people understand what the culture is in a you think about a lot of this process is very there's some big quantitative elements. You've got a lot of people who specialize in the quantitative side, lots of analysts and stuff and poring over the numbers and building models and all the rest. This actually gives them something quantitative, but that talks to the qualitative element around culture. It could be a nice little addition.
oh, I think that's huge. I mean, especially these acquisitions now with people working remote and that the cultures. And I mean, is this something where you add this company to your a platform company and everyone gets along and they grow, or is it civil war happening on day one? I mean, it's you know it's a big deal. And how do you
Mm,
really know these companies how they'll gel pre-transaction?
mm.
So I mean,
It,
like you said,
it's all
having that information on the company itself, it's huge. It really is huge.
But what I'm hearing you say, Shaun, for the benefit of our community, is uh, in terms of thinking about maximizing valuation or trying to get a premium over another business that's, if you put two businesses side by side, an A and B, and they've actually got exactly the same revenue, exactly the same EBITDA, exactly the same number of people, they sell the same products and so on. What are the things that is going to get one a premium versus the other? And actually, what you've articulated is reverse engineering what somebody is going to consider higher risk. So it's like, what are the things that are going to increase my risk profile with this business? Okay, well, they don't have processes and systems well documented. They're not, so if somebody leaves in the leadership team, that thing's going to fall over. Or the founders actually, it doesn't have a strong leadership team full stop, and the founder's doing 6 jobs. And so when the founder leaves, or if the founder leaves, depending on whether they're staying or not, then you've got a massive problem and you've got a huge kind of vendor cliff sort of risk scenarios. You're almost sort of reverse engineering all the things that people are going to be looking for as, red flags or deal breakers, and trying to make sure all of those things have been well thought about so that as they start doing that digging, they're actually, this is stable, this is believable, this is trustworthy, this is solid. And that starts to, because if you think about what does the multiple represent for the buyer, well, that also represents how long it's going to take them to get their money back. So if they're like, well, what's going to make them pay 7 times versus 5 times? Well, they've got to be comfortable with that. If the business, they're obviously not going to buy the business not growing, but if the business wasn't growing, it's going to take them 7 years to get their initial investment back before they make a dollar. So they then want the business to grow. They then want to have some other synergies they're going to be able to add on top. That's what, is going to help them feel like they are willing to pay a premium. But if they can see all these red flags everywhere, they're quickly turning into the territory where they're like, well, this is going to have to be bought pretty cheaply because we've really got to protect our money here. And we may have some, turning around to do, or some major problems that might come up, and it really starts to change the price someone's willing to pay, right?
Shaun, I wish I just said your answer.
No, I just got to summarize your answers. So that was good. That was helpful. That was helpful. So I'm conscious we're almost at time, Shaun, and I've got so many more questions that I would like to ask you. So if you're willing to come back for an episode 2, I would love to book some time with you to do that, and to to keep digging if that's okay with you. But can I ask maybe one? We had a little bit of dialogue offline about strategic versus financial buyers, because there's some people that are very wedded to it needs to be that you're only going to get a premium if you sell to a strategic. And I understand there's a lot of benefits for that. So maybe you could just explain the difference between a strategic and a financial buyer for a business this size, $2.5 million. So maybe they've got that option. What does a strategic versus a financial buyer look like? And why would you choose one over the other? Or why would you sort of go after, as part of your strategy, one after the other? Talk to me about your thinking around that.
I think that's really interesting, especially now, because things are kind of changing in a way for companies of that size. 2.5 million EBITDA. For a strategic, think of it as someone in that space that has that business, that this technology or the company could just be rolled into. Fantastic. You got the financial buyer that's going to be looking at it as EBITDA and going, okay, whatever we invest in, hopefully we get these returns. And they're looking at more of a financial base, or at least that's kind of been the history of it. And so strategics, because there's so many other things that they can add to it, and in the past have added a premium that the financial buyers, even with all their thinking, okay, I could pull this money out and recapture this, they haven't been able to meet. But at least the conversations I've been having recently, things are kind of changing where those private equity groups are getting in and giving multiples similar to those strategic buyers. And some of that is because there's just so much money on the sidelines right now. There's so much money that these private equity groups have raised that they're going, hey, we got to start deploying this ASAP. And, we're just not seeing as many of those companies as in the past. And there's so much money competing for them that we have to kind of change our risk profile. We have to kind of change what we're offering these companies. So conversations I'm having, strategic, financial, lately they've been pretty comparable, which is pretty interesting.
That's really interesting.
So, I mean, who knows if that changes in the future or not, but as of right now, the decision between one or the other, it's a tough decision.
Yeah. Yeah, that's really interesting, because it does feel like that's changed a bit. And so I guess, even it's like if we went back 7 months ago, people were finding getting money out of venture capital pretty easy. And then 4 months ago, not so much. Locked up a little bit tightly at the moment. And but I think to your point, if you think about, let's say you're this education business. So I in working with a publicly listed company that I mentioned before, that's really interesting opportunities. They had significant databases of employers. So very tight relationships with employers, who all wanted training. So we were looking for businesses, for training businesses that were really strong with consumers, who didn't have good relationships with businesses, where immediately they'd be able to introduce those education businesses to the businesses, and all of a sudden they've got a completely new revenue stream. It helps their existing customers. They're getting now access to the EBITDA of the business they've just purchased. So they're going to be able to create a kind of accelerated amount of value out of that business, because they can cross-fertilize the customers in two directions. So that's a good example of a strategic buy. Now, they were willing to pay more than perhaps market rates as a result, because they knew they can create more value. They didn't have to take any money out of the business. It wasn't a cost-cutting. It wasn't a financial engineering type opportunity. It was just purely they could see revenue. They could see increased returns, because they actually thought they had revenue synergies as a result of the nature of that group. Or they also thought they could reduce risk, because they had people in their business capable and already knew and understood this business model. So if the founder leaves, or the directors leave, or some managers leave, no big deal. We've got people we can deploy straight away. We know we can turn that business around. We're not going to lose a lot of money, because we know what we're doing. They're not buying something they don't understand, and therefore it's all the risk is within the people who are running it. So just for people's benefit, that's a kind of example of maybe a strategic buyer who would have perhaps in the past paid a premium. But if financial buyers are also really going, hey, we need to get some deal flow happening here. Like, we've got some capital we've got to deploy. And if you're in a financial business, then you've got a fund. So you've got a whole bunch of people's money that you've just raised, and you've got $100 million to deploy. That's an expensive problem to have if you're not deploying it, right? Like, you've got a timeline ticking until those investors want their money back and want their return. So you got to get deploying. So to your point, then that's probably putting some positive pressure on the amount they're willing to pay, which is pretty handy. So I know we've gone for a bit of a longer than usual podcast, but this is a great conversation for me, Shaun. I'm really enjoying it, having it with you, and I think it's super valuable for our community. So would you be willing to come back and do another episode with us?
Well, I mean, anything for my twin brother. So yeah.
Awesome. Well, and one other thing I should say, maybe I could put this. If there are people in the audience who would like a copy of a sort of a due diligence checklist, not a specific one for your industry, but just a typical one, feel free to email us at questions@scalupspodcast.com. Happy to send that over to you. It's not going to be a prescription. Obviously, you work with an advisor, they're going to tell you exactly what it is that you need, but it gives you an idea of, like, when you're building a data room, if you've never really thought about this before, the kinds of basic information that a potential purchaser might be looking for from you. So we'll get you a copy of one if you would like that. Shaun, it's been wonderful chatting to you today. Where would you direct people to for more information, or to get in touch, or to follow along with what you're doing?
So if you want to find out more information about myself, what I focus on, so mid-market investment banking, mergers, acquisition, growth capital between that $10 and $300 million transaction size, connect with me on LinkedIn, just Shawn, ShawnFlynn, Shawn Flynn, investment banker. Or you could follow me on thesiliconvalleypodcast.com. That's thesiliconvalleypodcast.com, where I interview entrepreneurs, venture capitalists, and leaders in tech. So between those, it's easy to get a hold of me. I love having conversations. Going back to our point today of a year, 2 years in advance of any type of transaction, I mean, that's the best time to start dialogue. So please reach out to me, and I'll do my best to answer ASAP.
Thanks a million, Shaun. Folks, I hope you got lots of value out of today. I'm sure you did. And make sure you tune in next time for my next conversation with Shawn Flynn as we unpack more about how to optimize your outcomes in a sale process. Let us know what you got out of today's show on LinkedIn. You can tag myself. You can tag Shaun once this episode is live. You've been listening to the Scale Ups podcast. I'm Shaun Steele, and thanks so much for joining us. We'll speak to you again next week. Thanks, Shaun.
Thank you.
G'day everyone, just a couple of quick things before you go. If you have questions that you'd love myself or an upcoming guest to tackle about challenges that you're facing in scaling your business, please just jump straight on the website, scaleupspodcast.com. You can record your message straight from your mobile by hitting the button on the right-hand side of the page, or you can just email them the old-fashioned way, questions@scaleupspodcast.com. And just a quick reminder, nothing we spoke about today constitutes financial or business advice. If you are considering making big decisions in your business, seek out a professional who can look at your situation in detail and make sure you're getting sound, personalised advice. Thanks for listening. Look forward to being back in your podcast feed next week.